In this lecture, we'll learn about mutual funds and other investment companies. By the end of this lesson, you'll understand the appeal of these institutions for people like us. And I'm betting you'll like what you see. Why do I think you'll like them? Partly because they offer diversification at low cost, and partly because they're just so darn convenient, especially for people just getting a start on building their portfolio. The idea behind a mutual fund is that although you may not have a lot of money to invest, and your brother Alan doesn't have a lot of money to invest, and somebody you've never met in Nevada doesn't have a lot of money to invest, if we can get enough of us to pool our funds, then we can do a lot more together than we can do individually. We'll all throw our money into a pot, buy stuff with the money, and then we'll share the proceeds depending on how much each of us contributed. We'll be able to buy lots and lots of different stocks so that we'll all be diversified. If we want to hire a professional money manager, then we can do that if we each chip in maybe 1% of our investments. We'll save on research costs for analysts because we're buying many stocks. You see, if we have just one stock, then we may need an analyst to research that stock for us. But if there are 20 stocks in an industry, then we don't need 20 analysts to follow that industry. That's because when someone studies, say, McDonald's, he has to learn about its competitors, like Burger King, too. As a result, we certainly don't need an analyst for every single fast food stock. We'll save on administration and record keeping, too. Mechanical tasks, such as distributing dividend payments and corporate mailings, can be fully automated. We can easily reinvest any distributions we want. Or we can take the cash if we want. It's just as easy for the fund to keep track of 1 million people's capital gains and dividends for the IRS as it is to keep track of 1,000. Thanks to automation, we'll even be able to hold a fraction of a share in a company. The fund might own 1 million shares of General Motors stock, and my money might buy 1.4 shares of those 1 million shares. That's no problem. The rest of the fund owns 999,998.6 shares divided among everyone else, depending on how much each of them invested. It's easy for a computer. Because we'll be buying large blocks of stock, the commissions we pay will be smaller. Economies of scale allow for reduced transactions costs and lower fees. We'll see that they may not be as low as they ought to be, but they're lower than people like us can get on our own. We'll have simpler record keeping too. All of our investments will be with one financial institution, and all of our information will come on one statement that's a lot simpler than it would be with 50 different stocks listed. Yes, there's a lot to like about mutual funds. Mutual funds aren't new. In fact, they're downright old. Kurt Hollenhorst of the Yale School of Management reports that a Dutch merchant and broker named Abraham van Kettwich started a fund that he named Eendracht maakt macht, which means unity creates strength. That was way back in 1774. Want to guess why 1774? Holland suffered a financial crisis during the previous 2 years, and van Kettwich's goal was to give small investors a way to diversify and spread risk. The idea of pooling funds to allow diversification is an old one indeed. Van Kettwich's fund invested throughout much of the developed world. Hollenhorst lists Austria, Denmark, Germany, Spain, Sweden, Russia, and even colonial plantations in Central and South America. The key innovation of van Kettwich's fund was the pooling of resources and diversification, not what the fund held. The fund didn't actually hold stocks. Van Kettwich's investments were more along the line of bonds and merchant banking, that is, direct investments in business and trade rather than shares of a company. Not too much else happened with mutual funds until the middle of the 19th century, when a Swiss fund started in